Hey, it's Dan Morales, and this is Homebuyer Radio. This is episode number 162. I apologize. When I posted episode number 160 and 161, I actually flip-flopped them in doing that. You can tell we've been really busy because normally I'm pretty on top of that stuff, but somehow managed to get those two episodes flip-flopped. Well, this week in episode number 162, what I want to talk about is a mortgage credit certificate, or what commonly goes by the term of an MCC. What a mortgage credit certificate is it is a dollar-for-dollar tax credit. Now, these mortgage credit certificates are typically issued by a state housing finance authority. Now, in a recent episode, we talked about state-specific housing finance authorities and how they offer, special programs that are typically, available for first-time home buyers, or those buyers who are low to moderate income, or buyers who are buying a home in a specific area where the state is trying to maybe encourage home ownership. Now, one of the programs that many of these state housing finance agencies offer, if you will, is what's known as an MCC, or mortgage credit certificate. Now, these mortgage credit certificates are typically separate from, let's say, some of the loan programs that these states offer, and typically you cannot use the two together, meaning that you can't use, let's say, a state housing finance agency's special mortgage program in conjunction with, let's say, a mortgage credit certificate. So I want to make sure you understand that they're two totally different things. But the MCC, or mortgage credit certificate, is a dollar-for-dollar tax credit towards your federal tax liability. Now, what happens is these mortgage credit certificates basically allow you to take a dollar-for-dollar reduction in your federal income tax based on a percentage of the interest that you've paid on your mortgage over the course of the last year. Now, in Michigan, where I'm at, that, if you will, credit is equal to 20% of your mortgage interest that you paid for the year. So let's just say over the course of a year, you had a $5,000, you paid $5,000 of interest on your mortgage. You have a 20% credit. So that 20% credit is the equivalent of $1,000. So you are able to write off $1,000 of any income tax that you would owe. Now, that's a key word there, being owe, because too often, lenders explain these mortgage credit certificates as though you can get a bigger tax refund when you use the MCC as part of, when you file your federal tax return. That is not the case. So if you've been told that, I just want to make sure you understand that that's not the case. What happens with these mortgage credit certificates is you can use them to offset a tax liability, meaning that in this case, in the example I just gave you, if you had $5,000 worth of mortgage interest, you get a 20% credit here in Michigan for the MCC. That's equal to $1,000. That tax credit is worthless unless at the end of the year you owe $1,000 in federal income tax. So let's just say you went through, you did all your, you filed all your, tax return information, or you got it all together, if you will, and you figure, oh goodness, I owe $1,000 in federal income tax at the end of the year. Well, you can use that mortgage credit certificate to wash that $1,000 that you owe. Now, in the case that you don't owe $1,000, then unfortunately that mortgage credit certificate was worthless to you in that tax year. So you have to have a tax liability to have the mortgage credit certificate have a benefit to you. Well, how do you create a tax liability if you're used to getting large tax refunds at the end of the year? Well, how you create a tax liability is by adjusting your withholding so that you get more money per pay period, and you actually, if you will, create a tax liability at the end of the year because you reduced your withholding per pay period. So in other words, if you're somebody that normally would get a tax refund of, let's say, $2,000, you need to adjust your withholding so that you don't get a $2,000, if you will, tax refund, and you create a $1,000 tax liability. So that means you have to have, if you will, $3,000 more come back to you over the course of the year as part of your paycheck so that you create this $1,000 tax liability that you would use the $1,000 mortgage credit certificate to offset. Complicated, right? So, long story short, what happens is by adjusting your withholding, you get more money per paycheck. Now, by getting more money per paycheck, you are able to afford your house payment that much easier. Now, in addition to being able to get, let's say, that tax credit, it also makes it easier to qualify for a mortgage because most lenders would take the value of that tax credit. So like in this case, if you have $1,000 that you receive, you take that $1,000, divide it by 12, and then what they would do is they would add that to your income when you qualify for the mortgage. So it makes it a little bit easier to qualify for a mortgage, and it makes it easier to be able to afford being able to, have a larger house payment because now not only are you not going to get a tax refund, you're going to create that tax liability. The goal is to kind of break even, right? When it's all said and done, is to create enough of a tax liability that you can use all of the mortgage credit certificate to offset that tax liability, which in turn puts that much more money in your pocket every time you get paid. So this is kind of a little more complex, mortgage product or add-on, if you will, to understand. Now, what's neat about that is oftentimes you can use this mortgage credit certificate in conjunction with, let's say your typical FHA loan, your conventional loan, with, pretty much any mortgage that's out there. You generally can use an MCC with, pretty much any mortgage product that's out there. What you're going to want to do is you're going to want to make sure that you understand the terms for your specific state. Like I said, I know here in Michigan, the value of that MCC is 20%. In other states, it could be higher or it could be lower. I know there are some states where it's actually higher, and there are some where it's probably a little bit lower as well, too. So it's something that's been around for a long time. I figured I'd just record kind of a quick podcast and talk about that because, somebody's going to probably find this episode as they're searching for information on mortgage credit certificates or an MCC. But it is a really neat program that has some really nice long-term benefits for you. It just helps to make that house that much more affordable for you. Hey, again, I'm Dan Morales, America's Mortgage Man. My NMLS number is 709-729. My phone number is 616-931-4629. You can find me online at danmorales.com. That's DANMORALEZ.com. And of course, North Point Bank is an equal housing lender. Have a great day.